Our next guest has a year-end S&P target of 3,800, which would mark a pretty big drop. Piper Sandler chief investment strategist Michael Kantrowitz joins us now. I think you were bearish going into this year as well, Michael, and the market's set to end pretty high, much higher than you originally expected. What was the big surprise?
Well, I think some of the big surprise was how much some of the Magnificent Seven stocks and the bifurcation within equities lifted the index this year. You know, it's been a year where there's been the haves and the have-nots, and the haves have been the larger components of the index. So, you know, clearly we don't think, well, I would say I don't think the market's going to end at that low level. I think it's a bit disingenuous to change the target with, you know, a couple months left in the year. But we continue to tell our clients, institutional investors, to remain in higher quality, higher profitable, higher interest rate companies that can withstand a continued backdrop of macro volatility and macro uncertainty.
So is your price target next year reflective of the fact that you don't think it's going to be the mega caps in tech leading again?
We haven't put out an official number for the year for 2024 yet. And I think in general, you're going to continue to see a quality bid and a further crowding into these Magnificent Seven type stocks across different parts of the market. And this has not just been a story within tech. Companies with similar attributes within financials, within industrials, have been the leaders within their space as well. And so, sure, you know, the larger names are where we've continued to advocate being overweight. And if they continue to hold up the index, then so be it. But again, we're looking for areas of the market that are going to lead and lag. And we've been kind of record-breaking or broken record bears on talking about not getting into the recovery trade or trying to go long small caps and other cyclical areas of the markets like regional banks, retail, and autos.
All right, but right. So, I mean, the market right now, the S&P is around 700 above your year-end target. So I would assume, though, going into next year, you're not going to be particularly positive.
Yeah, I think we'll be seeing further insight of the lagged effect of policy continuing to work its way through the system. We now have an unemployment rate that's up to 3.9%. And so, you know, I think while everyone's debating whether or not we're going to have a hard landing or not, where we actually have a lot more conviction is that we are not going to see a broad-based earnings recovery. And so, again, the market is where it is because of the construction of the index and because of a few names that are up 70, 80%. I think the average S&P is up 3% this year. And so I think this bifurcation will remain very much intact, if not widen further, unless we see some miraculous stimulus be put in place that helps to lift the economy in a broad way, which is not something we have seen really since 2021.
All right, Michael, thank you for joining us to talk through the thesis. Appreciate it.